Hey, Janice.
Hi, Anthony.
Today we'll explain what is the capital gains exemption for home sales. So this is another simple tax break that's available to just about everyone. There's no fancy lawyer or accountant necessarily needed, and you just kind of need to know about it to be able to take advantage.
So today we'll talk about what is the capital gains tax, what's the home sale exemption, and what about rules and limits.
And lastly, I'll talk about how to use this exemption to start compounding your wealth, which is something that we've talked about in actually prior episodes. So make sure you stay tuned for that reminder.
Absolutely. And subscribe and please comment. Give us some feedback. We would like that.
Cool. So Janice, can you start off by giving us your understanding of what is capital gains tax?
So I'm going to give you layman's terms, the non-lawyer, non-IRS terms is, so capital gain occurs when you sell an asset for more than you purchased it for. That's just the basic. So for example, stocks, that's just one. Let's say that you bought it for $100 2 years ago, right? And you sold it for $1,200 2 years later. So right now, see, I did some math there. What's your profit? $1,000, right? So there's a whole calculation and lots of stuff that goes into this, but essentially in my tax bracket, I'd have to pay about 15% on that. Mm-hmm. That's the generic version of capital gains. Now,
hold on a second, Janice. Does Pennsylvania have a state capital gains tax? I'm just curious.
That's a great question, to which I do not know the answer.
Nice.
I could Google it, but that's about all I know. Yes.
Okay. Well, for the most part, I know you're mentioning the 15% federal level capital gains tax, but most states have something in the range of 5%. So it is generally safe to say that a person's capital gains will be right around 20%.
That's definitely because the state always wants their little piece too, right? Is that, yeah. So of course, that's the very simple version of capital gains. Maybe you could give us a little bit more of an in-depth version.
No, you did a great job.
Okay.
I mean, any profit you make on any investment, whether it's stocks or a home or small business or Bitcoin or
right.
Anything. Yeah, any profit you make, the government wants 20% of the profit, not of the total amount. So if you sell something for $1 million, but you bought it for $900,000, your profit isn't $1 million. It's just the spread, right? It's just what you made.
Right. Yeah. So that, which is good because the profit on $1 million or for just $1 million outright would be pretty high. So
cool. So let me get into now, what's the exemption? What's this tax break that everyone is able to get? So it boils down to this. When you sell your primary residence, you don't have to pay capital gains tax on the first $250K of gain, $250,000 of gain, of profit. And if you're a married couple, you get to double it up and you owe no tax on your first $500,000 or $500,000 of gain. Right? Let me give you a quick example to make sure that kind of sinks in. What are the round numbers we like to use? All right.
No, the math. Okay, hold on.
So let's say you buy a studio or a small house for $100,000. I'm like so New York centric. That's not even possible. But anyway, I know that's a lot of money in a lot of areas. So let's say you buy a house for $100,000 and you're single and you live in it and you sell it for let's say $300,000, right? So your gain is the $300,000 that you sold it for, less the $100,000 that you paid for. So your gain is $200,000.
That's math I can do. $200,000, yes.
Very good. So normally you would owe 20% tax on that $200,000, which is what, $40,000. Someone double check me on that, please.
Yeah.
So that's a lot of money for $40,000 in tax. That kind of stinks, right?
It would hurt. Yeah.
Right. But if this was your primary residence and if you meet all the rules, which we'll get into in a bit, then no, you don't owe anything because that gain was up to and beneath the $250,000 limit. So you basically just saved $40,000 in tax.
That's huge.
That's nice.
Huge. Yeah.
Janice, is it worth going over an example for the $500,000 situation?
I guess it's the same concept. I mean, if you're a couple, you have a house and it's under, I mean, that's a big profit to have to make on a house to actually have to pay that.
Yep. So basically you should, in most parts of the country, you should almost never pay capital gains tax on your house. Right? That's a bold statement, but I think that's very true for the vast majority of the country.
So there are rules and limits,
Yep.
but I think a lot of people fall under these categories, and so you have to live in the home for at least 2 of the past 5 years.
Yep.
So it's not rental homes, right? Like, so if you rent a home but you don't physically live there, this doesn't count. Like, you'll have to pay the capital gains if you sell it.
Correct. This only applies to your primary residence, and it must have been your primary residence at least 2 out of the past 5 years. It can be the first year you rented it out for 3 years, and then you lived again in the last year. Any permutation of that, but it does have to be 2 out of 5.
Okay. And then, so if you meet that rule, you can use it as many times as you want. So if you're one of those people, which we enjoy, that moves all the time, but they've lived there and it's their primary residence, you can use this as many times as you like. I don't think there's a limit, is there? You just,
nope.
If you move a lot, then, which I guess, you know, when you think about it, there's how many military families do move every few years.
Yeah, it's not just
one example.
The military example is a good example, but this brings me to my final point about how to use this exemption to, really start compounding your wealth.
Yeah.
Way back in episode number 7, we had Britt Foshee on. Yeah, Britt Foshee is a real estate investor, and the way he and his wife really began building their real estate empire was by, I guess the word is exploiting this exemption, or you could say, smartly using this exemption. Yeah. It required a lot of moving, like you just mentioned, but they would buy a place, fix it up, live there for 2 years, and then rent it out for the next 3 years, kind of making money or at least breaking even for those next 3 years. And they would make sure to sell before they crossed that 5-year threshold to make sure they still qualified. And all the gain was tax-free, and they would just roll that money over into the next place, and they would keep moving every couple of years and keep buying. And now Britt and his wife, I think, own, I don't want to misquote the numbers here, but it's a very, very impressive, I guess you'd call it a real estate empire. They own many multifamily buildings. They own their own home, obviously. And they've done very well.
But they're not doing anything wrong. They're doing exactly sticking by the rules and using it to their benefit. I think it's a great idea.
And this is not something that you need a special tax haven or an attorney to bless or create special documents for. 2 out of 5 years, you live there. It's free money sitting on the table right there for you to pick up.
Oh, I like that. Definitely interesting.
Yeah. That's it. I think that's all. I mean, I feel like it's a simple concept that not enough people know about, and even those who do, you kind of forget about it. You need to take advantage of this. This is free money.
Absolutely. Like you said, you've just done the math earlier. You said $40,000, but you're not. You qualify because you live there. So that's $40,000. That's pretty amazing. So please subscribe. Definitely comment in the notes if you have any questions or any remarks, and we'll see you next time.
All right. Thanks, Janice. Thanks, everyone, for listening. Take care.